In the previous episodes, we looked inside quantitative models and followed a formula into a production system. Now we need to zoom out. Because a bank account, a payment app, and a stock exchange can look like separate worlds, they are not. Underneath, they coordinate the same basic things: money, ownership, obligations, and trust. A useful way to see the financial system is through two connected sets of records. One records who owns money. The other records who owns a financial asset or who owes money to whom. Banking, payments, and markets create, move, and update those records in different ways. Imagine a company needs $10 million to expand. It can ask a commercial bank for a loan. The bank evaluates the company, prices the risk, and, if approved, records a loan that the company must repay. The company receives spendable funds in its account. That is one core role of commercial banking: providing accounts, collecting deposits, evaluating borrowers, and creating credit. But the company could instead raise money through the capital markets. It can issue shares representing ownership or bonds representing debt. When investors purchase those securities from the issuer, money moves toward the company, and financial claims move toward the investors. That is the primary market. Later, investors may trade those securities with one another in the secondary market. The company usually does not receive the money from each later trade, but the market still provides liquidity and price discovery. So banks and capital markets can both fund economic activity. They simply connect money to borrowers or issuers in different ways. But how does the money itself move? That is the payments layer. A payment is an instruction to update financial records. If the sender and receiver use the same bank, the bank may only update its own ledger. One balance decreases, another increases. If they use different banks, the institutions must also settle with one another. Messages are authenticated, obligations may be cleared or netted, and final balances move through interbank infrastructure. A card payment adds more participants: the customer, the merchant, the issuing bank, the acquiring bank, the processor, and the card network. The customer sees one tap. The system sees authorization, clearing, fees, settlement, possible reversal, and reconciliation. Payments move money. Capital markets move ownership and financial risk. Banking provides many of the accounts and credit relationships supporting both. Now suppose you use a brokerage app to buy $1,000 of shares. Your broker sends the order to a market. The order matches with a seller. A trade has now been executed. But execution does not mean the transaction is complete. The buyer still owes cash. The seller still owes securities. This is where clearing begins. A clearing system calculates what each participant must deliver. It may net many trades together, turning thousands of individual obligations into smaller final amounts. In some markets, a central counterparty also stands between buyers and sellers and manages the risk that one side fails. Then comes settlement. Cash moves to the seller's side and securities move to the buyer's side. The system tries to coordinate both transfers so one side does not deliver while the other fails. This is the idea behind delivery versus payment. The money and the asset move together. Then custody answers the next question: where is ownership maintained after settlement? A custodian keeps position records, safeguards assets, processes dividends and corporate actions, and reconciles holdings. Behind the custodian, a central securities depository may maintain the market's central records of securities and settlement positions. So the single line in your app saying, "You own this share," may sit above several layers: your brokerage account, the broker's books, custody records, settlement infrastructure, and a central securities system. This is also where central infrastructure fits. A central bank anchors the monetary system and often provides the settlement asset used between banks. Payment systems coordinate interbank money movement. Exchanges provide price discovery and execution. Clearinghouses calculate obligations and manage counterparty risk. Settlement systems complete transfers. Custodians and securities depositories maintain ownership records. These institutions are connected, but they do not perform the same job. They divide one financial lifecycle into specialized responsibilities. So let's replay the stock purchase from beginning to end. Your money begins in a bank or brokerage cash account. Your broker checks the order and the available funds or credit. The market matches the order. Clearing calculates what the buyer and seller owe. Settlement exchanges cash for securities. Custody updates ownership. Banking and payment infrastructure move the money, and every participant reconciles its own records afterward. One click in the interface, several coordinated ledgers underneath. That is the complete connection. Banking maintains accounts and creates credit. Payments move money. Capital markets create and trade financial claims. Clearing determines who owes what. Settlement completes the transfer. Custody preserves ownership. And central infrastructure provides common rules, controls, and finality. A fintech company may make one layer easier: a wallet, a digital bank, a lending platform, a brokerage, a trading venue, or a financial interface. But it still connects to this larger system. The interface may become simpler. The underlying responsibilities do not disappear. And once you see the system this way, finance stops looking like several unrelated industries. It becomes one coordinated network for creating credit, moving money, transferring ownership, and completing obligations. But the map still leaves one practical question. When you click Pay or click Buy, which system receives the instruction first? What messages move next? And when does the transaction finally become irreversible? That is the life cycle we need to follow next.